So for the second time, Marvin, please kick us off.
Wonderful people. Sorry and sincere apologies about Google Meets and the Zoom link, and happy that everybody could figure out and join us today. So we started a bit, but here we want to run through again, just quick intro, high level, what we're talking about, what will be discussed, what you will learn. And in this workshop today, we designed it so that you can understand what is necessary when you're fundraising, especially when it's terms of due diligence. So preparing your due diligence for a round to raise money. Introduction to Raise. Some of you may or may not know, we are a company and software and platform that helps African startups raise money, manage cap tables, and automate legal diligence and compliance. So a lot of what we do, and we've seen a lot of companies and operate a lot of companies, we've been a part of a lot of transactions, and we see the same things happen over and over again. And we wanted to break this down and just come back to the foundation, the root of all of this stuff, and talk about what a cap table is. A cap table is short for what is a capitalization table. Capitalization is legally the term that you use to define what it means when someone is putting money or investing money into a company, and that company's growth over time. So a cap table, a capitalization table, at the very root is a record and a share registry of who owns what in a company. So this person owns 50% of the company, this person owns 30% of the company, these other people own 20% of the company. That is what a cap table is meant to do for you. And when you are raising money, what you essentially doing is updating the cap table to add a name, issue shares to that person, or issue stock to that person, or equity or convertibles, and enter that person into the registry for a certain amount of money that they would have invested. But cap tables are painful. On the right, you can see what a typical Excel sheet for a cap table looks like. They are just very clunky. It's like we dealing in the 1930s when we dealing with cap tables. They're very painful to deal with. And when you think that you finally solved it, they get more complicated over time. And the painful part is that most companies don't deal with cap tables until it's very too late. That's because you don't always really need them unless you're fundraising. But ironically, you can't really raise money if your cap table has mistakes on it, if it's not clean, if there's questions about it, it's going to be a lot more difficult to raise money. And all companies are guilty of it, including us, including myself, including many of the different entrepreneurs and founders I talk to, and we all talk to on a daily basis. And there's two things we see a lot. The first is that you end up selling more of your company than you think you do. So you might think that you own 90% of your company right now, but if you took the convertibles, if you took the stock options, if you added up all that stuff, realistically, you at 20%. It's like the difference of looking at your account and seeing that you have 500,000 shillings, but you have a debt of 600,000 shillings. It might look like you have 500,000 shillings in your account, but technically you're losing money. Cap tables are the same thing. You might own 90%, but actually you own 25% of the company. And the second thing we see a lot is that companies wait until they're fundraising to actually fix the cap table. So what that means is that you're definitely going to slow down the investment process. When you're fundraising, every week counts. As a real life example, we just lost about 2 weeks of fundraising activity, not lost, but we had to spend 2 weeks doing diligence. So we feel this pain. That's why we build this platform. And it happens to the best people. And that's because the cap table and the company starts off really simple. So you can start off with a Nigerian or Kenyan company when you start off your company. But over time, that company becomes a lot more expensive. And the mistakes that you make, or any issues or unforeseen things that happen on that company, get significantly more expensive as you grow. You can start off with a mistake that cost you 300 naira that suddenly balloons to a few billion naira in cost and legal fees. So at Raise, what we do is provide one platform. You can sign up at getraise.io on our website. And in there, what you're doing is managing the cap table, keeping your stuff clean, keeping your documentation clean, making your fundraising process a lot easier, and building valuations for your companies. And we built it such a way that it's just one place to do these things, because we just found that you had to use so many different softwares and so many different tools to do one simple thing, which is managing your company. And since you spend so much time trying to manage your company, you can't focus on your product and go to market and all these different things. So we've built the platform, we've built these workshops, this education specifically for companies that are building technology or products or businesses for the African continent and African diaspora. And there's two ways to get online and raise. The first is a priority on board. Priority on board means that you are going to be our focus. So when you sign up for priority on board, we have a team of lawyers, securities and corporate lawyers. We have a team of people who worked at venture capital firms. We have a team of people that work on the customer success and growth side. So we get you on board as fast and as simply as possible. And the second way is to sign up at getraise.io or getraise.cloud, where you sync your data, you upload your data yourself. And then from there, once your company is ready to go live, you get access to all the different features we were mentioning before: managing cap tables, building valuations, automating your legal compliance in different jurisdictions, and building valuations for the company. And today, at the end of the workshop, if we hear from our incredible panelists, in a few minutes, we're going to be distributing to everybody what we call a founder's toolkit. And we built this because it makes your life a lot easier. In that toolkit will be a due diligence checklist. So if you follow all that data and those questions, you'll have finished your due diligence for a pre-seed and seed round, especially if that's what you're raising. The second thing is going to be many, many different free contracts. So financing agreements, safes, convertible debts, share purchase agreements, a bunch of different things that will be super useful as templates. We always advise that you pass those through your lawyer, corporate secretary, or local counsel before you actually use them. And then all these documentations in that toolkit were built for companies building on the African continent. So whether you have a Nigerian entity or a Kenyan company or a Delaware company that owns a Nigerian or Kenyan company, we built it for that use case. So this is a quick high-level introduction in what we discussed in today, the background, what we discussed in today. So I'll pass it over to Rushab, who's leading us today, to hear a bit more from our panelists and their experience with dealing with cap tables and fundraising. Thank you, Rush.
Thank you very much, Marvin. I'm glad to have all of our audience members here. Once again, apologies for the confusion earlier, but it's great to have you. And we're looking forward to a very, very great, very good webinar today. It's my absolute pleasure now to introduce Conrad, the managing partner at Adili, to talk about the partnership between Raise and Adili. Over to you, Conrad.
Thank you very much, Rushab. Good morning, good afternoon, good evening to you all, wherever you are, and thank you for joining us. As Rushad has mentioned, I'm the managing partner at Adili, a corporate advisory firm, formerly known as Axis. We provide companies with corporate secretarial and administrative services, including setting up immigration services, outsourced payroll and accounting services, share registration, escrow services, fiduciary services. Adili operates across Kenya, Tanzania, and Uganda, and we work with corporate law firms across Africa to ensure compliance with relevant corporate legislation and execution of financing transactions to private and public companies. We're very pleased to have recently partnered with Raise and are in the process of developing a digital service that will make it simpler for our clients to manage their corporate compliance, equity, and documentation. The service will be first available in Kenya and will thereafter be rolled out in the region. It will essentially make it easier for our clients to track documentation and deadlines for annual returns and other compliance needs at the business registration services through automated notifications. It will also make it easier for clients to sign routine documents like annual returns, financing agreements at a click of a button. It will also make it easier for and request improvements to share structures and board of directors changes through the dashboard. Through the integration, Adili and Raise will onboard initially 500 companies and build features that make it easier for Adili clients to track their compliance status and automate most of the corporate processes, including annual returns and other statutory returns and share transfers. Through the integration, Adili clients are onboarded within minutes to a dashboard with their compliance and documentation data. Henceforth, important documents and requests will be filed automatically in the dashboard and easily accessible to clients. The partnership aims to create a robust data security framework for the platform and its user base. Allow me to conclude by saying that we are very excited to be working with Raise in this partnership to simplify the management of corporate compliance and equity across Kenya and indeed the region. Simplifying compliance requirements is a core part of our mission, and we are confident that the platform will go a long way in improving our client experience. Thank you very much, and over to you, Rashad.
Thank you very much, Conrad. It's really, really good to hear about the partnership, and we're very excited to move forward to the mutual benefit of all of our clients. So, to our audience, it's really good to have you all here. I'm going to quickly run through the agenda for today, and then we'll kick off with really the meat of what we're here to do today, which is talk about cap tables. So, of course, we've just had our introduction from Marvin, and we've heard from Conrad about the partnership between Adili and Raise. So from here, we're going to move over to our actual question and answer session. Before we open up the floor to everyone to ask questions, in our conversations with you, the audience, we've noticed quite a few questions that were coming in that were very, very common, and we've bulked them up into a few questions. So what we're going to do first is we're just going to quickly run through those FAQs, if you will. That should really set the stage, and for a lot of you who might be confused about some of the terminology, some of the technicalities, we'll be able to touch on some of those aspects, which should have you much better positioned to ask questions when we move over to the open section. So we are going to kick off with that now. But first and foremost, it is my pleasure to introduce our panelists today. Between our 5 panelists, we've got a wealth of experience. I think today is a very unique opportunity to get access to such great minds with a variety of experience, both in top international firms and also who've worked quite a bit in the investment sector, in funding startups and helping founders grow their companies. And we'll move on to those introductions now. I'd like to kick off with Rajiv Daya. Please tell us about yourself. Please give us your introduction.
Great. Thanks very much, Rashad. Firstly, it's a pleasure to be here and to join for this, what's probably considered a boring but very, very essential subject. So hopefully we can add more excitement to it since it's such a critical part of a startup's journey. Quick intro. I'm representing Founders Factory Africa, where I head the investment team. And just quick context, Founders Factory is a global venture builder. We are backed by corporate investors around the world, operating in multiple sectors. We've got a combined portfolio of over 250 tech startups, which is across the UK, the US, Europe, and Africa, who've collectively raised over about $500 million. So we operate incubator and accelerator programs. The African version has been operating since 2018. So we're backed by the Standard Bank Group, Netcare Group, and Small Foundation. We've got about 30 startups operating across the African continent, across fintech, health tech, and agri-tech, looking to get to about 90. So, we've got a pretty ambitious goal. We've got people in Johannesburg, Lagos, Nairobi, Cape Town, London. And the one thing maybe to stress is that I think we exist to serve founders at that pre-seed, seed stage of investment, which is, it's historically been quite challenging in our market because it's significantly underrepresented. So that's the area that we're looking to drive the most impact and really help founders, especially with things like cap tables. So looking forward to the discussion and pleasure to be here.
Thank you very much, Rajiv. And yes, definitely quite an ambitious target. Best of luck moving towards that. Next, I'd like to introduce Manutu. Please do tell us about yourself.
Hi everyone. Thank you for making time to have a chat today. So I'm Manutu Waigi. I'm the CEO of Ongoza. Ongoza is an ESO, an entrepreneur support organization. And what we do is provide holistic assistance to our network of partners, entrepreneurs, and funders. So through our 4 key pillars, which is Wezesha, which is a learning and management platform. We have business development services as our second pillar. And the objective there is to engage in project-based assignments across our stakeholders. Thirdly is our marketplace. In particular, we create stores for our entrepreneurs and we help them market their products both locally and internationally with partnerships across DHL, Flutterwave, and also other local service providers. And finally, fundraising, which is our 4th key pillar. And the objective there is to connect entrepreneurs to like-minded investors and vice versa. So our goal there is to ensure that both entities, entrepreneur and investor, are matched equally to ensure a mutually beneficial relationship. So I'm looking forward to our discussions today, and I'm excited to be here. Thank you for the invite.
Thank you very much, and great to have you. I should also note that Nirutu has actually taken on quite a few CEO roles and has a lot of entrepreneurial experience building cap tables, approaching investors. So his experience will be very, very valuable today. Michelle, please do tell us about yourself.
Sure. Well, hi everybody, wherever you are, pleased to be with you. So I'm the co-founder and the managing director of an incubator, an accredited incubator based in Mauritius. We serve early stage startups, a little bit of acceleration then. So we basically help them move from ideation to MVP, then go to market. And this is where investment happens and all the beauties of cap tables and the consequences. So I'm certainly not an expert in that, but I'm familiar to the concept and the implications for startups. I've co-founded an organization, a non-profit organization, who wants to tackle the early stage investment phase, which is a valley of death in Mauritius and certainly for many other regions in Africa. So we gather private investors and we structure their work. We try to make it the most professional possible. And of course, cap tables is one of the key aspects we're contemplating here. So again, no expert, but I hope I can learn a lot and share experience and perspective from the startups themselves, the incubator, the angel investing. Thanks.
Thank you very much, Michelle. And I'd like to say that it sounds quite humble. I do believe you've got a bit more experience than you're letting on. It's really great to have you. So of course, Rajiv, Manutu, and Michelle are our external panelists, as you've heard, with a wealth of experience between them. It'll be great to hear from them. I'd like to introduce our internal panelists. So these are people who work at Raise and have a lot of experience with clients, onboarding them, helping them structure cap tables. Tina, please tell us about yourself.
Hi, everyone. My name is Tina Nyamache. I'm the CGO at Raise. I've worked in the startup ecosystem for the last 5 years, roles in VC funds, accelerator incubators, and now a startup. So I have been running a couple of investment readiness programs across the continent, and I'm really happy to be here today and talk about the importance of cap table management and share our experience of conducting company due diligence processes and also onboarding hundreds of companies or cap tables into the Raise platform. So thanks again for your time.
Glad to have you, Tina. Fane, please tell us a little bit about your experience and background and what you can talk about today.
Good afternoon, everyone. Pleasure to be here with all of you. I am Fane Kimuma. I am a co-lead of the legal engineering team at Raise with a background in governance and legal compliance. I work with our clients who are majorly in the fintech space and help them build a cap table, maintain and manage it, and also help with the due diligence process of the cap table and before you start your fundraising. I am honored to share the knowledge that we have with you and to be here with all of you. Thank you.
Thank you very much, Fane. Yes, so as you can see, we've got executive level experience here, as I mentioned, across varied industries, across both sides, investor side and entrepreneur side. We've got people who've spent time coaching as well. So I think we've got a real panel of experts that we can gain a lot of knowledge from today. It's great to have you. So as I mentioned earlier, we're going to kick off with some of the FAQs, some of the questions that we've got quite a bit from you, the audience. So we'll start off with that, and then we'll move over to the open question segment, where we'll open up the floor to you. You can ask your questions directly to our panelists. In the meantime, the chat is also available, as is the Q&A if you have any questions about what we're opening up with. So we'll start with the basics, really, for the people who don't quite have that much experience with cap tables. And a question that we got quite often was, what is a cap table and what is a cap table's role within fundraising? So of course, Marvin told us a little bit about what a cap table is, but maybe we can dive into some of the more technical aspects of it, some of the legalese that might go past us if we don't have the requisite experience. Fane, would you mind telling us a little bit about some of those terms and what they mean?
Sure. Thank you, Rishabh. So I'll start off with what exactly a cap table is. This is a table that shows or reflects the shares of a company and who owns them. So there are a lot of components in the cap table that we need to get into. And the first one would be share classes, shareholding, equity, and at the same time, rights. So delving into it, in the beginning, when you are founding a company and you need to register it, it goes hand in hand with your cap table. So when you register your company, you have to register the number of shares that your company will be holding, or will be allocating to your shareholders. So what is, who is a shareholder? A shareholder is a person who holds a share in your company. So that would be your founders, that would be your directors. And in an instance whereby you have an angel investor while you're starting up, you might have the option of allocating some shares to them. So shares also is one of the components, and a share is a unit of value in a company. I will get into equity, and equity is the value of an asset after you remove the liability. And then next, I will get into what share classes are. So while you're structuring your cap table, you have a total number of shares, let's say it's 1 million. But as you continue to grow your company, as you continue to operate, you might, in an instance, want to employ a few people to help you in this journey. So in your cap table, you will classify your total number of shares into different groups, into different units, which are differentiated either by their names or the rights that are attached to these share classes. So if, for example, I have a company and I'm giving it to Rajiv as an employee in my company, so I will put a share class named employee share class, and I will allocate it to Rajiv, to Tina, to Marvin, and to Rishabh, for example. And then I will get into what a right is. A right, as I mentioned, is attached to a share. So a right is the invitation for my existing shareholders in my capitalization for them to either purchase additional shares at a discounted rate than what the market value of that share would be. Yes, that's all that I have right now. Rishabh.
Thank you very much, Fane. And for the audience, we will be sharing a cheat sheet with you just in case some of those terms didn't quite stick, because obviously they are technical. We'll probably have a few other terms in there as well. feel free to ask more about them in the open question segment. We'll be happy to dive into some of the details and how to think about them as you approach investors. Right, so moving on from there, obviously that's the theory of it. Manutu, with his experience, I think is willing to give some of the practical experiences that he's had. Manutu, would you mind telling us a few stories about that, and really what isn't a cap table, and what are some of the misconceptions that we have when we talk about cap tables?
Yes, thank you. So my last painful experience that I had regarding not doing this properly was running a company called Umati Capital. And with Umati, it was a fintech that focused on the ag-based ecosystem across Kenya and East Africa. So when we first started the company, the challenge that we had is that we had to find some sources of capital around kicking off the organization. And you literally beg, borrow, and steal from friends, family, and the other F, which is usually the fools who are willing to invest in you. And the challenge with that is that you strike various deals to get you going, and you forget to detail the structure of that deal. So for instance, on some groups of people, we struck a deal that we would pay back once the company reached a certain level of funding. And with another group of people, it was an agreement that the organization pre-revenue was valued at a certain amount. And by the time they do exit, they want to sell their shares at a certain amount. Now, that means that if you don't keep track of all of this that's happening and you focus on running your business, when you do come to sell or raise another round of funding, the valuation of the company significantly drops because you didn't think through how best to structure your shares. And secondly, as a startup, we tend to sell quite a lot of our shares because we usually don't have faith in our business. And if we do, you end up selling quite a large chunk of equity because you're being forced by somebody who's saying, hey, I'm taking a massive risk in your company, so I'll take a significant stake of between 15 to 25%, usually not more, for a very little amount. Now, what ends up happening is you end up working so hard to bridge the difference that you generate so much value, but you're generating value for the investor. And if you don't keep a cap table that's up to date, you'll end up actually losing your company and owning very little share of your business. So I've seen some pretty horrific cap tables in my time. And the worst one was one where the company had over about 100 investors whom were crowdsourced capital from the beginning of the company. So somebody gives in $5,000 here, $2,000 here, $20,000 here. And over time, you'd find that the entrepreneur themselves held on to less than 6% of the company within 7 years of the organization running. So these are all pretty linked issues. And the advice I'd give to the entrepreneurs here is you have to get into a negotiation whenever you're dealing with a cap table and investors, especially in the early stage of your company, or else you end up losing a lot of control later on when things actually matter. And you can actually be kicked out of your company if you don't have a well thought out cap table from the beginning.
Thank you very much for that, Nutu. That's quite valuable experience. Obviously, we benefit from your mistakes, unfortunately, here, but I guess that's why it's really, really great to have you. So the next question that we got asked quite often. Actually, you know what? Before we jump over to the next question, we had prepared a poll for you, the audience, to get a feel of where you are. So I'll jump over to the poll and let's see how well we actually understand the different terms that we've described and whether we need to dive into them a bit more. So we'll open up the poll for you. Please just go through it. We'll give it a couple of minutes and then we'll get a feel of where everyone stands.
And the poll should pop up on your screen. If it doesn't, just type in the chat box.
Well, we'll start throwing up the results of the questions as they come up, but please do continue with the polls. Right, I think we'll just let that run for maybe 1 more minute before we show all the poll results. Yeah, so we'll just let that run for 1 more minute. Right, so we've got some interesting results here. Obviously, there's a range of experience here. And as you can see, I'm going to share the results. Right, so as you can see, we've got quite a range of understanding here. So it seems like a lot of people, I think the general concept of cap tables, bit of an understanding, not really a full understanding of that. As we dive into equity, I think there's a bit of a better understanding, but there are a significant chunk of you who don't quite have that experience, and we'll definitely dive into some of the details so that we make sure that we're all covered. Shareholding, I think, is quite a well understood concept. I think the idea of owning a chunk of a company, that's fairly straightforward. So that was an expected result. Share classes, I think, is where it starts to get a little bit more complex. And we've got a bit of a poorer understanding, I should say. So we'll definitely dive into that and try to break apart some of those concepts and see how that affects your fundraising as we move forward. And finally, the concept of dilution and how different funding rounds will affect how much of your own company that you own. That's something that's quite important with the growth and survival of your company as we go forward. So we'll definitely touch on that. But it looks like there's a bit of confusion around shareholding. So we'll definitely spend some more time on that. And make sure we can really unpack that. So with that in mind, actually, it's quite important to now think about what factors we should be considering as founders, as different companies move towards fundraising. So given that information, given we should be talking a little bit about share classes, we'll dive into that. We'll dive into how you should approach an investor. Michelle has quite a bit of experience, both on the founder's perspective and the incubator's perspective, and just some of the information that he looks at when he actually considers investing in a company, and maybe some of the larger theory to think about as founders now start approaching investors. So Michelle, maybe you can tell us a little bit about that.
Yes, sure, pleasure. So first of all, please, if you allow me, I was pretty intrigued and interested in the results here. So I see that 30% of the audience do not get dilution as a concept, and 40% rate their knowledge of share classes as absent. So for me, that's a clear indicator that, and that's my experience as well, that usually the awareness and knowledge about cap tables is minimal. It's about I have a venture, let me sell you the value, give me funding, let's call that investment, and I give you shares in exchange, and that's it. And then all sorts of funky conditions that you can add in an opportunistic way. And basically, ignorance can lead to very, very, very terrible stories. And I was shocked by Munyutu's example of the guy who started with crowdsourcing and ended up after a few years at 6%. So that's certainly extreme. But that's a good indicator that people should take care. And I think that is pretty normal. In the incubator, when people come to us, they come with a solid conviction that they have found a solution of the tough problem and that their venture will thrive. So they are super obsessed and focused on product and market. Go-to-market and product is their scope of mind. So they seek money to fund that and they ignore the rest. So that's pretty much common, I think. And our role in the incubator is to broaden the perspective, to help people grasp the complexities of what they are trying to accomplish, so the whole journey, but componentize that in a sequence so that they don't try to tackle everything at once. Of course, they need to get funding, but they need to take care of partnerships, communities, human capital, intellectual property, and all sorts of things. And our advice, our coaching here is any decision you make, think about the longer term. But I don't want to be too long here, but just to conclude, reversely, longer term informs the short term. So when we ask people, what is your ambition? To give you two extremes examples, some of them would say, okay, I want to exit in 3 years and I want to maximize my profit here. Some will say, I want to build a long-lasting venture and be the CEO of some multinational African company. And of course, we respect that, but it's a very, very different approach in those cases.
Yeah, thank you very much for that. And I think it's important to understand that all fundraising is not the same, and how our dilution changes across time is quite important in the context of how you expect to grow. Manutu, you've got a bit of experience with this. Could you tell us a little bit about that and how you prepared your companies for fundraising from a cap table perspective?
Truth of the matter is, it's only until after my last large company, which is Umati, which is about 2 odd years ago, and I haven't founded a company since, that the most painful event happened. And just as Michelle explained, we were so busy with building the product, focusing on the market, growing the team, and what have you, that we forgot to take into consideration about all factors, including dilution. And when it was explained to us in detail, even at the sale of Umati, even though we were worth at some point, when we started, we were valued at about $1 million. And we got a $400,000 injection from Axion Venture Labs. At that stage, we were so excited with the funding that came in that you overlook the future. And it's true, if you don't plan for the future now, it becomes very painful later. That eventually, when the company had to fold due to a fraud that happened with one of our clients, you think you're safe until you find out that based on the class of shares that you had given away to, not given away or sold to a batch of investors, you find that those class of shares means that they have priority over us as the founders. And at the time that we were signing, we were taken over by the excitement that, oh my goodness, finally we have some capital to run the business, get us away from, you know, eating Roman noodles for dinner and stuff, that you sacrifice your future sanity for an immediate good. So my experience with cap tables, and that's why I really wanted to be part of this engagement, is moving forward in the companies I will decide to found, cap tables becomes the forefront discussion, and you almost have to make a stand as an entrepreneur of what it is you're willing to take and not accept. Because as time moves on, it becomes very difficult for you to raise more capital, yet the business needs capitalization. And you end up taking a very raw deal, especially when the investor is aware that they are likely to take advantage of you and you're more desperate than they are. So my advice, hello, can you hear me? All right, cool. Yeah, so my advice is, please take this very seriously as entrepreneurs. Read into dilution and cap tables and types of shares, because the more complex investors you accept within your organization, the more that they'd require, including aspects such as vesting of shares. And when we first started Umati, we were told that our shares would vest over 4 years. And you're like, wait, firstly, what's vesting? You discover that vesting of shares is basically telling you that they don't want you to mess up in the event that there's a scandal related to you, or they just want you vested in the fact that you'll keep pushing for the greater good of the company. Then we discovered that they wanted us to vest over 4 years. And what that means is whatever shares that we had, they keep giving it back to us over a 4-year period, which then begs the question, and like, wait, so who owns the company for you to be vesting the shares as a founder? So we had a fight with our initial investors and we walked away from them. And eventually they came back and they scrapped the vesting. So there are numerous factors that we need to consider as entrepreneurs that we usually not communicated to in the beginning of running a company. And the landscape will only get more complex and more investors are coming into our continent. And we need to be well versed about these terms or else it stands to be a very painful engagement.
Thank you very much, Maniju. Yes, I think the key message here is as a founder, you have to protect yourself. You have to realize that you're going through several rounds of funding and you can't give away too much equity at the start. I think it's important to sort of understand the investor's perspective as well when looking at a company. Rajiv, maybe you can dive into what you look at as an investor when you're looking at a company, when you're looking to invest in a company, and what factors, what considerations do you take when actually looking at the cap table of a company you want to invest in?
Yeah, thanks, Rishabh. I think for me, the way I like to think about this is there are two types of documents that you can have in your business as a founder. There's a static document and there's a dynamic document. So a static document is your articles of whatever it is, depending on where you're incorporated, right? So it's your incorporation documents, it's your shareholder agreements, it's those documents that are typically in PDF format, right? That are static. And then there's the dynamic document. So when you're working as a designer or a product person, you've got the documents you work on collaboratively. When you're working on fundraising, there's a financial model and those sorts of things. Now, here's the reality. The reality is that when you're thinking of the shareholding of your company, you should have both a static document, which is your subscription agreements or shareholder agreements, safe notes, whatever it is, your financing agreements, and you should have a dynamic document, which is typically in Excel, but now that companies like Raise are in existence, you don't need Excel. Little plug for Raise. And the reason that's important is most founders don't necessarily spend much time on the dynamic version of a static document. And what that allows you to do is scenario planning. So as an investor, when we're talking to startups or startup founders, we would expect an understanding of the different scenarios that could play out based on the terms contained in your static document. And if you have that set up, whether that's in Raise, whether that's in Excel, Google Sheet, whatever, as long as you've got that set up well from the beginning, you don't need to spend much time after that, because when you get into a discussion with an investor, whether it's us, a VC, whoever it is, you can very easily talk to the terms that are contained in your static agreements. And that's the key, I think. And so from our perspective, if you've got that understanding, it's really important. And having the ability to use that when thinking about how you plan to raise in future rounds is one of the criteria that we look at when assessing founder skill set from a technical perspective, because you need both the technical, the commercial, and obviously the product side of that sort of capability to be a well-rounded founder.
Yeah, thank you very much for that. And yeah, I think it's quite important to really manage those documents across different all the different documents that you have, and have that kind of centralizes. It has, I know, led to a few issues in fundraising. At least I've witnessed that myself. But I think we tend to think about fundraising as purely equity, or just give away a chunk of my company for a chunk of cash. But there are a few different things that we can do. Tina, maybe you can expand on that.
Thanks, Rishabh. So yeah, in addition to equity, there's different types of funding or financing that you could opt for. So we have the debt instrument, which is purely debt. You can get a loan from the bank or anyone else and pay them back with interest. Or you can use convertible instruments. So this could be a safe note or KISS. which is a simple agreement for future equity, or the KISS, I kind of forget what KISS is. I'll keep it simple securities. And for this too, it's very easy to, it's like a one-pager. It's less legal documents to sign. So it's basically a promising equity in the future. A certain date when it converts into equity. Usually you can have a valuation cap tied to it, or also a discounted rate tied to it. But using compatible instruments sometimes can be a bit tricky, like Rajiv said. When they convert, you could either over dilute yourself based on the terms that you have agreed with the investor. So being careful by using scenario modeling tools to see how the convertible instrument would convert into equity is really important. So doing your research is key. And then there's also convertible debt instruments. It's similar to a debt instrument, but also you have the option to convert it into equity at that agreed future date that you have agreed with the investor. So for it's important for founders to understand the pros and cons of using these different financing instruments, but also there's common types of funding options that founders should also think about. So if you're planning to start your own company, or you've already started your company, you could, if you have the money, you can bootstrap, which is advisable to bootstrap as much as possible. But if you can't, there's also other options. You could go the route of crowdfunding, but we've also heard the disadvantages of using crowdfunding. There's also, you could do look for angel investors or early stage VC funds, or accelerator and incubators who can give you, in addition to either introducing you to investors or helping you get that technical skill support as you build your business. I think I want to reiterate what Michelle said. At the end of the day, when you're thinking about choosing your funding options, asking yourself that question, what do you want for your company as you scale? Do you want to still have the control of the operations of the company over time? Maybe that can give you, answering that question can help you decide what funding you should look for. Or if you're just looking to exit your company, then you have more financial options to consider.
Great. Yeah, that's definitely something to consider, especially because that obviously has knock-on effects on our cap table and what we finally own on our own company. Now, of course, as we go through these fundraising processes, the whole point of it is to have cash to be able to run our operations, to be able to grow, and really form something we're proud of. But there are several reasons why poor cap table structure might lead to the potential failure of our company. So I think it's good just to touch on that. So we'll kick off with Rajiv. Why do you think cap table structure is sort of vital to the survival of a company?
Yeah, look, I think the obvious one is the shareholding that a core founding team has, because that's your currency, right? So I start a business, I'm a founder. I typically don't have access to a lot of capital because I'm at the riskiest end of the spectrum. So I can't just go to my bank and get a loan. And so I start off with the 3 Fs that we heard about earlier. I can then progress to VCs and PE, etc. But all along that journey, the currency that I have is the equity in my business. So if I don't work backwards from my end state and think about how much currency I'm going to have left for each stage, then I give away too much too quickly. And when I really need, if I get to that sort of growth stage where I've now built something that's really amazing, there's product market fit, we're growing, we've got customers, Now we need a lot more money to scale a lot more aggressively, but I'm stuck because I've given away 70, 80% of my currency. So, at that point, you then either have to strike agreements with current existing shareholders to help you alleviate some of that. And the reason that investors are very focused on that, so one of the rules of thumb that's used in the industry is by the time you get to Series A, post Series A, you should still, as a founding team, own more than 50% of your company in order to allow for future fundraisers. And the reason that's in place is because investors want to know that the majority of the shareholders are the people who are actually invested for the long-term trajectory of this business, who are going to be contributing value over the life of this business. Investors, VCs, are there for a shorter period of time, and it's in their mandate to exit after 5 years, 7 years, 10 years, whatever it is. So it's to align long-term incentive for the growth and success of the business with the equity holding.
Great to hear. Yeah, very very vital information, I think. Fane, I think there's maybe something that we should touch on actually, which is regarding the country of incorporation and how that liquidity I should say. Maybe you can touch on that because I'm sure our audience would like to know what the impact of country of incorporation is and how that relates to the cap table structure.
Okay, thank you, Rishab. So on the two aspects, I'd say it all touches on the due diligence that you do before you start your fundraising. So do your research on which jurisdiction would favor your company as you grow. Making sure that as you go through fundraising, as you go from pre-seed to maybe Series A or Series B, the country that you are incorporated in allows you to grow too. Because I'll use an example of Delaware laws. Delaware laws are quite very lenient when it comes to how a company grows in the fintech space as compared to most African countries. Because here, our laws are trying to catch up with most fintech companies. So I'd say that's the first thing. And then the second thing would be in liquidity. As Michelle and Rajiv have stated, that you have to think long-term. You have to think of how your equity will liquidate over time. If in an instance whereby your company want to add in more shares in the next fundraising round, you have to know, if I bring in more shares, if I'm bringing in more investors in my company, how does it affect the already existing shareholders in my company? Will it get to a point whereby I, as the founder,
Yeah, we still have you. We still have you.
Thank you. My laptop just misbehaved. So yes, so where was I? I was stating that you don't want to reach a point whereby you find yourself, you have less than 5% of your company, and then at the end of it, you lose control of your dream or where you want to be, because outsiders have taken control of your company. So yes.
Great. Yeah, it's good to hear. I think a lot of us, we sort of think about, if our startup is operating in Kenya, it should be incorporated in Kenya. But from a fundraising perspective, it's important to think about where else we could potentially incorporate it, even if our operations are in a different country. Tina, you've seen a few deals sort of gone south, and you haven't invested in a couple of deals. And maybe that's led to poor performance of the company later on. Do you have any experience regarding that you'd like to share?
So a couple of them have been said. I think when you two mentioned a bit about having too many people in your cap table earlier on. So that is difficult for founders to manage their cap tables. And eventually at some point, if you're looking for funding, investors might shy away from joining your cap table. The other thing I've seen is a lot of outstanding safe notes and compatible debt instruments. So you could be fundraising for multiple, either VC funds, early stage VCs, or angels or individuals, and giving them different terms, like different safe note terms. And not thinking about, once this safe notes convert into equity, how much dilution would you get? And that's when you find when they start, when they convert, you might end up not being majority shareholder of your company, which when you're, as Rajiv said, when you're doing your Series A round, it could be difficult for you to get buy-in from, to get some investors in your cap table. The other thing I've seen is when there's the debt equity. So what do I mean by debt equity? So this is when you have people in your cap table that have common stocks and are no longer working for your company. So an example is you might have, let's say you have 4 co-founders. Each co-founder has 25% of the company. And for some reason, 3 of your co-founders decide to leave. And so that means 75% of the company is owned by people who are not in the company anymore. So when you're going to fundraise, you're approaching these new investors and you're telling them you only have 25%. So they're wondering, why should I invest in a company where majority shareholders of the company don't even work in the company? So that can make them not invest in your company. A way of mitigating that risk, and I think Nutu has talked about it, but he talked from the negative side of it, which could plausibly happen when you could decide to vest all your co-founders. Just making sure that when they leave earlier on, then some of the shares of the company goes back to the company. This is to protect yourself, to protect the company. And also when they're leaving, they leave with a percentage that they've worked for. Yeah.
Great, yeah, thank you very much. Rajiv, I believe you've got a few qualitative points to add to this. Maybe you can touch on that.
Yeah, thanks, Rishab. I think two things, more, as you said, more qualitative or philosophical. There's obviously the quantitative considerations that we're talking about, percentage equity, dilution, and calculating the different scenarios along the way. I think the 2 points I wanted to make, and there's a specific quote that comes from a book called The Messy Marketplace by Brent Bishop, and I've referenced this quote a few times in the last couple of weeks, and that is, you set the price, I'll set the terms. And there's a very popular or famous African VC, the founder of Echo VC, who uses the same phrase. And what we mean by that is a lot of founders can get stuck on the overall valuation when thinking about raising a round. And what is the pre or post money valuation? What's the valuation cap? And what happens is you get very stuck on that, and you don't look at the terms that are contained within the same term sheet, because you're only thinking about the dilution associated with the valuation of your company at that point in time. What you don't consider is other rights that investors could acquire in the same term sheet, whether there's warrants, whether there's preemption rights, whether there's rights of first refusals, and those, in theory, could have an even larger impact than the valuation that you agree on at that point in time. So, there's 2 elements to consider when thinking about your cap table and investment and talking to investors. There's the valuation of your business, but then there's all of the other terms contained within a term sheet. Won't get into too much detail around some of the other qualitative stuff, but just the second point there, from an investor perspective, is we also look at the types of investors that you choose to bring onto your cap table. Obviously, there's instances where you don't have the luxury of choice, and you have to take capital from wherever it comes from. But the other thing to remember is, to founders, from the investor perspective, there's also, when doing due diligence, there's also an element of, was there some thought put behind the types of investors that are coming, whether it's from different geographies or different sectors, where I've looked at this from a founder perspective in a two-way direction when thinking about where equity in my business is allocated and who's on my cap table. So also don't lose sight of that qualitative aspect alongside the quantitative.
Yeah, definitely a very valid point, because obviously the numbers need to be contextualized by the qualitative information and what we really were trying to do with our company. I think that's it in terms of sort of the FAQs that we had. Obviously, we've got quite a few questions coming in the Q&A box. So we'll move over to that. Derdus has been very active on the question and answer box, and we really appreciate it. So thank you for doing that. Before we move on to answering some of those questions, I'll just reiterate what I dropped in the chat a few minutes ago. If you want to ask the question live rather than dropping it in the Q&A box, simply raise your hand. There's a raise hand button that you can just smash. I will hand over the mic to you. I'll let you unmute your question, and you can ask your question. And I think that will hopefully lead to a bit more conversation and discussion rather than just a one-off answer. That way we'll really be able to dive into a lot of the queries you have. So yeah, once again, opening up the floor to anyone who wants to ask questions. Seeing as we don't have any raised hands yet, we will kick off with Derdus Kenga's question, which I believe Marvin is going to answer. His question is, what is the implication, maybe legal or economical, of the number of shares in your company? And how do you determine the number of shares at company registration stage? Marvin, over to you.
Yeah, there it is. Thank you for your question. I see actually a couple of questions you sent that are all kind of related. And I think I understand what you mean, because I've struggled with this in the past as well. Is when you create in a company, you have to basically allocate a certain number of shares when you create that company for the first time. And there's no manual. No one tells you, like, does it matter if you have 100,000 shares? How much is each worth in Naira or USD? Like, no one really tells you the importance of that stuff. But there's always a standard. So when you create a Nigerian company, a Delaware company, you'll create a certain number of shares every single time. So allow us to take you through a couple of visuals here and a demo of the Raise platform so you get a better sense. But the first thing you have to understand is that when you create a company, the most important foundation of the company, like the foundation, like a house, is called common shares. So when you're building up your company, a cap table for the first time, like Tina was saying, you issue common shares, which is typically held by the founders of the company and the founding team, and eventually as stock option holders. Once you've done that in an early stage company, you add on convertibles. So what that means is that you still have common shares that exist, then you add on these convertible instruments, people call them safes or convertible debts and things like that. And then those are issued to investors, but they get added on top of the cap table essentially. Then eventually as you grow, you want to add on stock options. So you basically take a certain number of common shares and you allocate them to be used only as stock options. So you'll say, yo, I want to create 10% of my total stock as stock options. And out of that 10%, we'll distribute it to the rest of the team who join in the team. So what's effectively happened is that you'll start off with a million common shares, for example. And then as the company is growing, what you're doing is basically adding on and creating more shares constantly, every round, every like growth, everything. So what happens here mathematically is that you go from having 1 million shares in a company to having 1,100,000 shares. So what that means is that you might, as Derdus, have started off the company owning 100,000 shares as an example, right? Out of 1 million. So that means you own 100,000. That's 10% of the company that you own when a company is created. When the company is adding stock options or creating different kinds of share classes to sell to investors or stock option holders, what's happened is that you are creating new shares, but the number of shares that you own as Derdus is not changing. So mathematically, what that means is that your percentage is decreasing, but then because the number of shares is increasing, but the number of shares that you hold is never really changing. The number of shares that your employees will hold is not changing. The founders will hold is not changing. What is changing is the percentage that they hold of the whole kind of pie of the company. And one really easy way to visualize that in the Raise platform. So this is a quick demo of Raise and what's available. You can view different assets by different classes. So you can see safe notes, you can see, the stock options we just talked about once your cap table is live, and the different rights and preferences, as well as tracking the vesting. Vesting is basically being distributed certain numbers of stock over a certain period of time of shares. So you might own 100,000 shares, but that 100,000 shares is going to be distributed to you monthly for 3 to 4 years, whatever it is. And one really good way of understanding the impact of all of this stuff is running a scenario on the Raise platform. So you'll say, my name is Derdis, I own, what's an example here? I own, let's just say 99% of the company. And after you raise a round, here I've just applied a scenario. So I know what I'm raising a certain amount of money. They'll say I'm going from owning 99% of the company to owning 76% of the company. So I've been diluted by a certain amount of money. And then you can use these scenarios, attach them to a deal room, and then these become the terms that your investors would see when you invite them to the deal room, when you invite them this way. So really what's happening is you're crunching the numbers, and it allows you to kind of start building the cap table so you can run many, many different kinds of scenarios, as many as you want. And in each of these different scenarios, we're doing different things. So to answer your other direct question about the stock options, when you answer in this question, you could even put how much percentage of the shares do you want to reserve for employees? So you'll say 10%, and then the platform will automatically put aside 10% of the shares specifically for stock options, and then tell you how much would be left. And all of that data is coming from the company that you set up initially onto the Raise platform. When you set that company up initially, you'll be providing a certificate of incorporation, all that stuff. So the platform always knows how many shares were issued initially, how much exist, how many were created, that kind of stuff. So over time, you both updating your cap table, tracking it, and being sure, like Rajiv was saying and Tina was saying, that you're not being diluted to the point where you own no shares in the company. So I hope that answers several of your great Q&A questions. If not, please type, raise a hand, anything that'll be helpful.
Yeah, thank you very much, Marvin. I think it was really good to visualize it, especially on the Raise platform. So of course, if any of you, hopefully that helped kind of build that image of what a cap table might look like, and sort of how to navigate the different elements of it. So I think Derdis had a couple of other questions, which we can kind of deal with. But before we go to that, Sadiq has a question regarding his fintech company. So his question is, I got into the startup world during the pandemic, and I've been building up startups right from secondary school days, from e-learning to robotics companies. Not until right after a workshop, I currently got into fintech. Your question is, I don't know how to raise a company when it comes to funding from pre-seed up to Series A and so on. And you don't know any VC or angel investors and how to get started with. So I think we're in a great scenario here, because I think between Rajiv and Michelle, we have people who are actually in the investment segment, investing in seed stage, pre-seed stage, and at an angel level. So I'd love to hand over for them, and maybe they can give you a little bit of advice with regards to how to approach investors. We'll start off with Michelle, who can give the angel perspective, and then maybe Rajiv, you can talk about pre-seed and seed level. So Michelle, over to you.
Yes, thanks. So it was rightly explained before that it's a sequence, it's a journey. So each actor plays at a certain moment. Of course, it's not black, white, clear cut, but there are certain rules that are applied all the time. So if you are just at an ID level, usually there are exceptions. You won't get funding except the triple Fs. Incubators would consider them at the project level, and then when you have an MVP, so working prototype, and you start to get what's so-called traction, which means that people get interest and are happy to put some money for, those are the early adopters. At this stage, yes, if you have proof of traction, you inspire trust, usually you have a team that is formed, you have already invested quite a bit in sweat equity, their business angel will come into play. But that's not a free lunch. So those guys, and I can tell you by experience now, they behave as professionals. So they do due diligence, they inspect the business plan, they consider the longer term, they check all sorts of things. And the cap table as well, of course. So it's a process. There is no rule. I think there's no rule in terms of how long it takes, but certainly not 2 days. And hopefully you can pass the valley in 2 months sometimes. But I've seen quite a few real life experiences, positive ones, that would last 6 months from the time you engage with the potential investor, and by the time the money lands on your account and all the legal aspects, cap table stuff, etc., are completed, it could be long. So it's a piece of work. It's a work in itself. That's why basically we prefer to invest in teams than in a solo show where you have one entrepreneur pretending to run sales, investors, and commercial.
Yeah, great to hear. Rajiv, would you mind providing your opinion, your 2 cents on this?
Yeah, so here's the good news. The good news is that when you look across the market that we operate in, the African early stage market, a founder who is really passionate, who's been building businesses since secondary school, who really knows a specific subject, who's super technical, but just doesn't have access to investors and the commercial side of things, that is the default scenario. And that is exactly why we are in existence as an entity, is because we're in a market, unfortunately, where you're not a Silicon Valley founder who can go to one place and access all the capital in the world, and you have to spend that much. Unfortunately for us, the investors are spread all across the world. It's very fragmented, and it's difficult to access them. So you are in a very, very common bucket. The bad news is that there's always trade-offs, right? So, you've got a fantastic business idea, you're a great person. The reason that most investors look for a combination of technical co-founder and commercial co-founder is because you do need to spend that time networking and speaking to people who are going to be potential users and investors in your business. Alternatively, accelerator, incubator programs are built for that exact reason. We spend all of our time figuring out that network, getting that network to provide access to founders so that you can continue to do what you do best. But there's a trade-off. So either I spend time and I go into a program that's going to help me on the commercial side, or I have to bring in a co-founder who's going to focus on the commercial, because you have to have a combination of commercial and technical to build a successful, scalable business. So there is a trade-off. There's no sort of one size fits all.
Yeah. Thank you very much for that. So we're going to move over to I think there's quite a few questions around investing. So what I'll do is I'll kind of I'll just mention some of them, and I think Fane is well positioned to talk about the mechanisms of vesting and sort of some of the thinking that should go around issuing shares to your employees. So the first question is from Derdes, whose question is, as the founders, do you also vest shares? If yes, how do you give out shares if you're receiving funding before you fully vest? So Fane, maybe you can take that, and then I'll jump into some of the other questions as we go, because I think that's slightly separate question to the rest and how they bulk up.
Thanks, Rishab. So from my perspective, not a founder perspective, but when it comes to employee shares being given out, I've seen a lot of founders go with the lane of including a vesting clause in these employee contracts or ESOP contracts that they're giving out, either incentive, phantom, or whichever type of employee shares it is. So this vesting clause talks about you'll receive an X total amount of shares, but for the period of 4 years. And in the duration of these 4 years, a percentage of the total number of shares will be vesting to the employee little by little. So So at any point whereby the employee either quits their job or stops the employment, then the company either has the option of buying back the shares and then stopping the vesting of those employee shares at the moment that the employee duration stops.
Okay, great. Dennis, hopefully that answers your question. So I'll roll up the next couple of questions because it talks a little bit about, I mean, we've talked a little bit about the mechanisms, but I think there are a few questions about, although it seems to have disappeared, what the sweet spot is in terms of how much you should be giving your employees. Is there a standard amount that you should be giving? I think that's that question we can roll up with Anya Dike's question, who's also asking whether that should show up on the cap table. So Fane, would you mind taking us through that as well?
Yes, thanks. So I've seen companies giving either 10 to 15% on their cap tables when it comes to employee share options. So the sweet spot comes in with how they structure the vesting of these shares. So you'd find that in the first year, there are no shares that vest. But from the second year of that vesting clause, you either get like 25%, apologies. From the first year, there's no vesting of any shares. But at the end of that first year, maybe 25% of the shares vest to the employee. And then after every month, you vest for 3 years in total. I hope that provides insight.
I believe it does. I believe it does. Let's continue further down. We've got a question here from, I hope I pronounce this right, please. My apologies if I don't. Okwidili. Her question, which I believe Michelle will answer, is good day, everyone. My question is a bit out of scope for the theme, but permit me to draw us back a bit. I'm a venture aspirant with only, oh, sorry. Seems the question was pulled away. Okay, so I hope that question was dealt with another way. Yeah?
Oh, sorry, it's me.
Yeah,
I was just typing the answer and I clicked.
Oh, okay, sorry. Well, maybe you want to just say that to everyone, just so that everyone has the benefit of your answer.
Yeah, sure, very briefly, but it's a typical ideation stage question. So the straight answer for me is there is plenty of incubators, and I would recommend to get in touch, get feedback, discuss, and start from there. So to get an idea of the journey, the different options of support that are at hand, but certainly not to jump on the investor side at that stage.
Okay, great. And I believe that question has been answered sort of via text as well in the Q&A box. So if anyone wants to look at that answer again, it will be there. We have another question from Jet Ride. Hi, I own a multi-service mobile app. I'm new to fundraising and I know a little bit about shareholding, but how I will be able to start with raising funds on Raise, because all I know is how much I intend to raise. Tina, would you be able to speak a little bit about sort of how much or sort of how to raise funds? I'm guessing this touches on both networking and the Raise platform itself.
Sure. I can start with you being a user. Using the Raise platform is the benefits is you have all your documents in one place. You can build your cap table, use your cap table to also build up like different scenarios. If you're thinking about fundraising, you know the amount you want to fundraise, but you're not sure which funding instrument you should use. Raise has tools for that. So you can, if you want to use compatible instruments, you can use our scenario modeling tools. to build up different scenarios and see how much percentage or you want to give away and use that as a term. So that, as Marvin had mentioned, that would, you can put that in the deal room. So you can build your deal room in the platform, which would be like a snapshot of your due diligence to start inviting investors. So we help you until, our team helps you to build your cap table. Our team helps you to build your deal room, prepare your due diligence process. And then we do have partners like Kina Rajiv is already on the call. We have partners like Ongoza, whom we can make introductions so they can take up that process after. When you're starting to prepare, they can introduce you to different investors. Also, I would advise you to look at when you're looking for investors, it's easy to find them, a lot of them in LinkedIn, looking at what types of investments that they've made, which industries that they're investing in. Maybe that can help you sieve and target the right investors. Reaching out to them, asking them if they would be interested in getting on a call with you. Mostly it's easier to get introductions to this with these investors through like a warm lead, like Ongoza or Parity. So they do introductions, they match investors to startups. I think that would be an easier route to take if you don't have any investors in your network.
I think it's worth pointing out, of course, that we will share details on how to reach the Raise team if you want to get involved with Raise and build your cap table there. And of course, we'll also share contacts of our panelists if anyone wants to reach out to them and speak to them. So I think that sort of covers that point. It seems that people are sort of asking for a bit more information about vesting and trying to dive into a few more details. Fane, I believe you on the chat mentioned that you'll touch on that on behalf of Tochi. Maybe after that you could hand over to Nirutu to also provide some details on that. So over to you, Fane.
Awesome, thank you. So I'll use an illustration of a vesting clause. So if I'm giving 100 shares to Tina as an employee at Raise, so these 100 shares will be vested to Tina for a period of 4 years, but with a 1-year cliff and a 25%. What does that mean? That means that in the first year of this 4-year vesting period, Tina will not have any shares that will vest to her. So by the end of the year of, let's say, the first year is 2019. So for the year of 2019, Tina will not have any shares that will vest to her. But the moment we reach January 2020, 25% of those 100 shares will vest to Tina. So that means Tina at 1st of January 2020 will have 75 shares that have vested to her. That's what a 1-year cliff with 25% means. And then the rest of the 25 shares will vest to Tina as an employee for the rest of the 3 years that she is working for the company. I hope that is clear.
I'll also mention sort of to the floor that we have a demo of the Raise platform coming up. And I think when Marvin goes through that, it will become a bit more visual for you. So for those of you who are still struggling with some of the concepts around vesting, I think we'll be able to break that down a little bit as Marvin goes through the demo. Before I hand over to Marvin to actually go through that demo, Munitu does have a bit of experience, as he mentioned earlier, around vesting and how he had to actually negotiate with an investor. Munitu, would you be able to provide a little bit more detail on that and the specifics on that particular deal that sort of that was interesting, that could be useful to our audience?
Yes. So at the time, what they had requested, which is the investor at the time, is one, we take a 4-year vesting period. And at the time, this was the first time I've ever heard of the word vesting. And what that meant, when we dug further, what we discovered is that, and also something we need to talk about, which is a pool, the pool of shares, is that when we discovered and we were told that with the vesting, it would vest over 4 years. And within the 1-year cliff we were given is that should anything happen within the 1 year that severely disrupts the operation of the company as a direct fault of us, the founders, that our shares would end up in the pool. In other words, they will end up unallocated. And from what we understood at the time is the largest shareholder controls access to this particular pool. So in retrospect, what I would definitely have done different is spent some time understanding the cap table and the terminologies, especially with regards to shares. And you touched upon something extremely important that is usually not discussed, which is around the jurisdiction of the company. So at the time, we were a lending institution and we were domiciled in Mauritius. And why is that? As a GBC2 company in Mauritius, our tax obligations were a lot lighter than being domiciled in Kenya, where we are taxed about 30% in Kenya, vis-a-vis about 5% in Mauritius. So your jurisdiction also plays heavily upon the type and quality of investor you recruit, which again comes back down to the cap table and time spent on the cap table. So for us, to answer your question directly, with regards to this particular deal, we were given a 4-year vesting period and a 1-year cliff. And luckily, we saw through the first year without issue, without any drama, to eventually where we ended up as an organization about 6-7 years later.
Okay, thank you very much. We've got a question here from Kelechi. Kelechi, I'm going to allow you to unmute yourself and you can go ahead with that question. Kelechi, you have the floor.
All right, thank you so much. All right, so my name is Kelechi and I'm a Nigerian, right? And so I have a question around valuation. I think somebody asked a question about the fact that he knows how much he wants to raise, right? But sometimes, right, I've noticed that you say, okay, I want to raise $50 million, right? And I also know the valuation, also the amount of money you want to raise also determines like your valuation and probably the cap table. How then do you now explain to the investor that for us to move to the next level, right, we need a lot of money to get a lot of licenses and all of that. We need $50,000. But they don't see it that way, or they think that your ambition is too unrealistic. How do you balance it? Do you understand what I'm trying to say?
Right, I see lots of nodding heads from our panelists. Does anyone want to take that on?
Sure, I'll take it on. So as an entrepreneur myself, having been in that position, there are many factors which you need to consider, especially when going towards investors. The biggest factor that you need to consider is you can easily forget that you're the one in control of the situation. And it's easier for the investor to try and guide the way the conversation will go, but ultimately do not forget that it is you that dictates how that engagement goes. I speak personally from experience. So the first round we did was about $1.2 million. And that took about 9 months for us to sort out. On the second round, we did about $1.2 million. And that we did in 3 months. What was different? So we instead gave the investors a very defined window at which we wanted to raise capital for. And we had already had a lot more traction in our second raise than we did in our first raise. So we told the investors we have a 3-month window. And this is the reasons why we have a 3-month window. So in the deal room, we had everything that they needed to review to make a decision. And we literally began the clock from the first moment we opened the deal room to the set of investors we had. And also, it's Kelechi, right? Am I pronouncing your name correctly?
Yes, yes.
Yes, and also there's a fact I'd like to tell you, which I wish was told to me some time back, that at the end of the day, there's also nothing wrong with organic growth. It's painful, it's slow, but you end up controlling a lot more of the narrative than traditionally just signing up to a large investor who comes in and, from what I've seen, prolongs the inevitable, which is your business actually generating revenue to self-fund or self-sustain itself? So it comes back down to attitude and also experience. And what I'm likely to do now, and as I've been doing and in advising a lot more entrepreneurs, is please focus on organic growth, innovative ways of raising capital. And as you look at innovative ways of raising capital, your cap table is definitely something which you need to take care of from day one. But also, it's also possible for you to find the right investor whom understands the urgency of a particular amount of funds. And I speak again from friends who have raised $47 million, and the challenges that they went through and the timelines that they went through. And it comes down to basically attitude. You need to change your mindset and by default change the type of investor you're addressing.
Okay,
Perfect.
thanks.
Yeah, so Kelechi, I hope that that answered your question. So we're just about out of time now as we approach sort of the end of this this conversation. I think it's been a very valuable discussion. I think we've discussed some very good points, and I hope that you, the audience, has walked away with a lot of knowledge that you can now implement in your own businesses. As I'd mentioned just a few minutes ago, I think some of the questions will be answered through a demo actually of the Raise platform, which will touch on some of those technical aspects that you guys have questions on. I'm going to hand over to Marvin now, who can go through that demo and then conclude for us.
Cool, man. Thank you. Vesting is not as intuitive as we would like it to be. So a couple things about vesting. You get issued 100 shares by the company, you own those 100 shares. But think of it as, okay, Roosh, you want to give me, I don't know, man, what's food that I like? Candy. So you give me 100 pieces of candy, right? I own those 100 pieces of candy. We've entered into a contract for you to give me that 100 pieces of candy, so I'm legally entitled to it. But you're only going to distribute those pieces of candy on a daily, monthly, whatever we decide basis, right? So I am owner of those 100 shares. So when I look at the cap table, you'll see that this person owns 100 shares, but they're being distributed vesting equity on a regular basis. And like Tina was saying really well earlier, and when you two alluded to, and so did Rajiv, you're doing this to keep people for the long term. There's different kinds of vesting. You can do vesting straight up on time, so by month, by year. You can do vesting on milestones, which is also cool. But most common thing is vesting on time. So here's an example on the Raise platform of a company that has demo company uploaded their vesting schedule. We can look at this example of Mambo Mata, who is a shareholder in the company, probably a stock option holder, so an employee. And his shares were issued on November 12th, 2019. And the end of his vesting date is in 2023 sometime. And his total amount of shares he's been issued is somewhere around 73,000. And that's about 2% of the company. And to date, he has vested about 40,000 of them, and remaining to be vested is 32,000. So that means that between November 12th, 2019 and today, because the Raise platform calculates this on a daily basis, he's vested this amount of shares. Between now and 2023, these are the remaining shares that are vested. So what you see is that every month, we highlight in green in the platform, every month a certain amount of shares is being issued. So here every month, Mambo Mata is receiving 2,015 shares. So at the end of every month, he's receiving a certain amount of shares. And then you see on the right, this is the total amount of shares that he's vested over a specific period of time, over these periods of time. So you can see this happening every month, and you can see that the next issuance of vesting is on September 1st, so in a few days, October 1st, November 1st, and so on and so forth, until Mata gets to the point where he's vested about the total number of shares. And then from there, there's stuff as well that happened with vesting and stock options, but this is how vesting works on a regular schedule. But when I look at the cap table here, you can see that Mata owns common shares, he's a founder, and then 73,000 shares, and the certificate for the vesting has actually been issued to him. So he technically is already an owner of these 73,000 shares, as evidenced by the share certificate, but they're being vested over a specific period of time. So that's one of the many features available in the Raise platform, and that's why we refer to it as an all-in-one platform, because you get all these things in one place, so your life becomes a lot easier. So I hope that helps Mata, about the example of Mata, and Rush, thank you for the space to do that demo.
Great. Yeah, thank you very much. I think that should hopefully touch on a lot of points that a lot of the questions that we had regarding vesting. We are just about out of time, although I do see Anyadike has had her hand up, or his hand up, sorry, for some time. Would the panelists be willing to just take that one more question before we conclude? If so, then I will allow you to speak. Yes, you've got the floor, Anyadike.
Hello, my name is Anyadike Caleb. I'm from Nigeria here. My question is, during the process of dilution, that's the company creating shares for investors to come in, can it be possible, or are founders also allowed to subscribe to that particular shares that the company wants to create?
Is your question to anyone, or is it just open to the panel?
Can you guys hear me? Okay.
Yeah, we can hear you clearly.
I can hear you. So my question is, are the founders allowed to subscribe to that particular shares that are created for investors? Like maybe the company want to bring in more investors, and then they create, let's say, 10,000 shares for the investors. Are those founders also allowed to subscribe to those shares, like, buying the shares as much as the investors are also buying the share?
Rush, thanks for your question. Fane, if you don't mind, I'd like to direct that question to you, just because that's related to contingency shares and stuff. So please, it's a very important one. You know I would do it. It's a very important one. Thanks for your question.
Okay.
Okay, thank you. So, legally speaking, you've set aside shares for investors of that round. Unless you as a founder are investing in that round, that's the only way you can be able to gain those shares, because when you're fundraising and you've set aside these 10,000 shares, remember that you're giving out terms which are meant to convert, rates and terms which are meant to convert into these shares. So unless you're one of those investors. But in an instance where in the future, where we're able to create a product that allows a founder to be part of those shares without having to put in money into your company, then that would be really great. And that's what you're working towards.
Okay. Thank you very much.
Rajiv, I think you said you've got something to add on this.
Yeah, again, I agree. Very, very important question, because some people may may assume that it's not possible. So my simple answer from a very, very practical standpoint is that anything is possible. So you can participate at any point. Assuming you are the majority, even if you're not, if you've got the funds to participate in any round, you are more than welcome to. And to take a legal standpoint, as a shareholder, you would also presumably have preemptive rights and those kinds of things to always participate as a shareholder. If you've got the funds to do that at a later round, no one can stop you. But I think some of the other things that people don't necessarily think about, I've just worked on a transaction a couple of weeks ago. We were doing a fundraise with a completely new investor, and the founder had a conversation with the new investors and said, look, I made the mistake very early on of giving away way too much equity to angel investors. However, I've got a great relationship with one of my angel investors who's willing to allow me to buy back some of my shares at this current round. So if you're willing for some of the proceeds of this round to go back to me, allow me to buy back some of those shares, it's going to help me clean up my cap table. It's going to help me with my founder shares going forward. So, you have that. You've got a call option, which you can include in term sheets. So as a founder, you're saying, I need your money today because I don't have any other sources of funding. But in 2 years' time, I may be able to buy this back from you at a pre-agreed price, at a market price at that point in time. So the options in theory are endless. It just depends on the relationship that you have with investors and the amount of flexibility, both liquidity-wise and legally, to execute on some of those options that you may embed in agreements.
Okay, thank you. Thank you. I understand.
Okay, great. That's good to hear. I think it's worth touching on just that. Get it down on paper. Don't sit on gentlemen's agreements. That's not a great place to be. I think with that, we're actually over time. We've gone 6 minutes past what we had scheduled for this webinar. I'm going to hand over to Marvin to conclude for us. But before I do that, I'd like to give a huge thank you to all of our panelists. You've been great. You've answered a lot of questions, and there's actually a lot more questions that I know the audience would have liked us to touch on. We will be doing regular workshops as we proceed. So keep your eye out for those. We'll touch on some of those subjects. And of course, we will be passing on contact so that you can reach out to some of us directly if you like. Marvin, over to you.
Thanks everyone for coming, panelists for being here and so attentive, for Zichi Sam, growth team for organizing this. Just a couple concluding remarks. To sign up at getraise.io to get started to go live. A reminder that there's 2 ways to get onboarded. One is a priority onboard. The other one is building out your company on the platform. Reach out to the growth and customer team if you want a priority onboard. It's significantly faster. We can get you set up, especially if you have a Nigerian or Kenyan company is currently incorporated, we can get you up within a day. So get contact with our team, our customer success team and growth team. They're all on the call. Kimuma, who we heard from Fane, Ozichi, Sam, who helped organize and put this workshop together like they did the first one, Patience and Tina, who are on the growth team. So just contact any of the team. The email is going to be dropped in the chat box in a couple seconds to get in contact. Otherwise, when you go to the website or to the platform, there's a little chat box at the bottom right. Reach out to there and people will be in touch with you immediately. And one of the things is a reminder from this call we've prepared. We have a team of lawyers who are incredible at what they do. And we built out a lot of different templates and diligence checklists, things that you need to fundraise with. We are fundraising now and we're using our own materials that come out of this Founders Toolkit. And we've helped other founders as well and companies and investors who use the same stuff. So when this concludes, you'll get a question with feedback through email. And once that's complete, you'll get an automatic toolkit delivered to you. And this isn't the end. Our community is always open. getraise.io. There's a lot of blog articles and stuff there available about this stuff, as well as the Founders Toolkit. So we'll see you at getraise.io and talk to you all very soon. Thank you so much for taking the time to be here. Congratulations on taking the time to learn about not always the most exciting topics, but the topics that are necessary if you're really trying to grow your company. So congratulations on making that effort.
Thank you.
Great, thank you all. And that concludes our show. All right, bye-bye, guys.